It's a great pleasure for me to introduce to you our speaker tonight, who is Alexander Ljungqvist, who is a renowned finance expert. He will talk tonight about the stock market and corporate investment, and he's an outstanding person to bring to your edification some of the ups, downs, ins, outs, dark side, bright sides of this particular device in our financial world. Mahatma Gandhi once was asked what he thought of Western civilization. And his response, "I think it would be a good idea." And some would say the same thing perhaps about this topic, that it would be a good idea to understand more how the markets work, how they have such a powerful influence on all of us, and why it's important for each of us to have some basic understanding of how it functions and what its impact is on the rest of the world. Professor Ljungqvist is one of our leading economists and finance experts at the Stern School of Business at New York University. He came there in the year 2000. He has won an enormous number of both teaching awards and research awards, including the 2001 Research Award for Outstanding Scholarship in this field of finance and entrepreneurship for a scholar under the age of 40. He also was educated at Lund University in Sweden and got a Master of Arts, Master of Philosophy, and his PhD from Oxford University, where he taught before coming to NYU. He is active as an editor and consultant for all of the leading research and economics policy boards and magazines, and I think you will find his talk tonight to be both fascinating and very informative, and he will definitely be happy to take your questions at the end of his talk. So without further ado, please welcome Alexander Ljungqvist.
Good evening, and thank you for coming to this talk. It's a pleasure to be here. It's my first time in Abu Dhabi. It's good to see the other half of NYU. So the subject of my remarks is the stock market, and in particular its role in funding corporate investment. And I think what I have to tell you is going to surprise you. I'm going to give you a relatively negative view of the stock market's role in funding corporate investment, certainly in the US. If we step back for a moment and think about what the stock market is for, then there are two main functions. The first function is called the primary function, not because it's more important than the other, simply because that's the terminology. And it's to do with helping companies raise equity capital for all sorts of things, including to fund investment. And they do that by selling shares to the public. They could do that by going public for the first time. Google went public in 2004, for example. Or when they're already public, they can raise further equity by selling shares to the public in a secondary equity offering. So that's probably commonly what we think about when we think about the stock market funding investment. It's the primary function of the stock market. But then there's also a secondary function. If you have a stock market portfolio, if you have investments and mutual funds and so on, really what you're doing is you're buying shares in companies and you're selling shares in those companies. You're not funding their investment. You're buying the shares from another investor, or you're selling the shares to another investor. So the secondary function of the stock market is provide a trading venue where investors can exchange shares with each other in exchange for cash. So that will provide investors with the liquidity for their shares, and that's going to make it easier for people to invest in the first place, knowing that they can get out of the investment again. The second role in this secondary function is to price the shares. So every time you and I sell shares and buy shares, we help establish the market price. And we do so by incorporating the information that we have and the market has about the company's future and prospects and so on. And what the share price then can do is to provide feedback to the corporate management about how it's doing. So imagine for a moment that a company announces the takeover of another company, and the stock market doesn't like that takeover announcement. What's going to happen is that the share price falls. Well, that's informative for management. They can look at the share price and infer that investors are not happy with the announcement. So we have two functions. The first is to raise capital, and the second is to trade that capital. And the secondary market really benefits from liquidity. Okay, so these are positive aspects of a stock market. But there's a dark side. Once you're a stock market listed company, certain consequences arise, and they can very well undermine the efficiency of the companies and the investments in particular. And this really arises because the ownership structure must change when you're a public company. So imagine for a moment that you're running a family-owned business. So it's you and your family, you own the shares. But at some point, perhaps because the next generation doesn't want to take over the management of the company, you decide to take the company public. So what you have to do in order to become a publicly traded company is to sell shares to the public. So now what you're going to have is your family owners, some of whom will have sold shares, and outside shareholders who are really only interested in the dividends and the profits of the company and what's going to happen to the share price, and not at all really any of the other intangibles, such as, is the company doing good? Is it being run for the benefit of the family? And so on and so forth. So academics refer to this process of inviting outside shareholders in as a separation of ownership and control. Ownership is obvious. By control, we mean who manages the company. So in a family-owned business, to a first approximation, the owners and the managers are pretty much the same entities, the same people. But in a stock market listed company, you have to have outside owners, so the managers no longer fully own the company, and they become accountable to outside shareholders. Now, what may happen because of this is conflicts of interest. When you have managers and outside shareholders not seeing eye to eye on what should happen, how the company should be run, for whose benefit and purpose it should be run, you may get conflicts of interest because incentives and interests become misaligned. This is something that academics have talked about for a long time in law, accounting, finance, economics, and so on. And it's referred to as agency conflicts, the manager being the agent of the shareholders and not necessarily managing the company and shareholders' interests. And the kinds of topics that academics have thought about in this context are to do with managers not working hard enough, playing too much golf or something like that, shirking in other words, gambling, excessive risk-taking. The banks in recent years would come to mind in that context. Empire building, managers enlarging the size of the company for their own glorification, or perhaps because their pay is tied to how large the company is that they run. Tunneling, which is a term which you may or may not have come across before, which is really a polite way of saying stealing from shareholders. So diverting cash or profits from the company to entities controlled by the managers, and so on and so forth. So separation of ownership control has to happen when you take a company public, and that may lead to problems. Now in the US, CEOs are very far removed from being owners in their companies. The average CEO in the US owns less than 5% of the equity of the company he runs. So most of the time, CEOs will pursue their own benefit rather than what is in the interest of the other 95% of shareholders necessarily. That's the first potential for conflict. The second is somewhat different. Given that we have separation of ownership control and these potential problems, it would be a really good idea if somebody monitored management, if somebody engaged in active corporate governance to ensure that management do what they're meant to do, which is to maximize profit and so on. But the problem is that monitoring is costly. Sitting on a board of directors or putting pressure on management one way or another is a costly activity. And when you and I own 5% of a company, we might just engage in that costly monitoring. But if we own 5 shares each in the company, we probably will not. So the ownership structure, again, is going to have consequences here, and it's going to undermine the incentives for corporate governance. And then there's a twist. Remember I said the stock market enables us to buy and sell shares very efficiently and in a very liquid manner. But that liquidity also undermines our incentives to monitor. If a company doesn't do what we think it ought to be doing, we could engage in costly monitoring. We could vote ourselves onto the board of directors and try and fire the CEO, let's say. But it would be so much easier just to sell our shares and move on to the next company. And we can do so very easily because the shares are liquid. So liquidity itself undermines the incentives for corporate governance. So by necessity, we have the potential for problems because we separate ownership and control when a company goes public. And by the virtue of this great benefit, liquidity, we may very well undermine our remedy for this problem, which is monitoring. So that's by way of background. Now, that raises the question whether companies should be public. And in particular, whether companies that are likely to suffer from big problems in this regard, agency and so on, companies that need a lot of capital, whether they should be public. And this is a question that's been around for a long time. What I've done here is to copy from the internet two of perhaps the best known works on the topic of agency problems in public corporations. On the left, you have a book that was published in 1932 by two academics called Burley and Means. And they were perhaps the first to make the argument that with separation of ownership control, you will have these agency problems. And on the right, you've got what is probably the most influential article in corporate finance ever published by Michael Jensen, who's now at Harvard Business School, and Bill Meckling on the topic of agency problems. So this article on the right was published in 1976. So you can see it's quite old, but not at all dated. So there's a large academic literature that's thought about this problem. Now, what I like to do is to think about the role of the stock market in funding investment in particular. And let me start by showing you some stylized facts. Stylized facts being facts that we think are facts, that look like facts, but we can't quite prove them. But here's some interesting statistics. The first is that most US companies are in fact not listed on a stock market. Most choose to stay private. Out of every 1,000 firms in the US, only 6 are public. There's a total of about 4,000 publicly traded companies in the US. And there's many millions of private companies in the US. Now you might say, that is not surprising because most companies are quite small. They're corner shops and so on. Of course, they're not public. And most firms in the economy are exactly like that, tiny little entities. But even when you focus on larger companies, it remains true that most US firms, even larger ones, are not stock market listed companies. So here are 2 additional statistics. Out of every 1,000 firms in the US that have more than 100 employees, only 46, 4.6%, are public. If you look at larger companies still, out of every 1,000 companies with more than 500 employees, only 99, 9.9%, are public. Even large US firms in the US, as a rule, are not public. That's the first fact. The second fact is that stock markets don't actually supply much capital to companies. So the primary function of the stock market is not actually very active in the US. Most stock market listed firms in the US never raise equity. Those that do don't raise equity very often, only every 3, 4, 5 years. Most firms never raise capital after their IPO. If you look at it differently and you look at the macro level, look at the economy as a whole, and you net off the flows and you look at how much capital is being supplied to companies via the stock exchange, you find that that amount is much smaller than the amount of equity that is withdrawn through the stock exchange. And by withdrawal, I mean companies paying out cash in the form of dividends to their shareholders and companies buying back their shares from stockholders. So there's more capital being returned to shareholders than being raised from shareholders on net in the US. So the stock market doesn't actually supply net capital in the US. That's the second fact. The third fact, which is an emerging fact, maybe a factoid, is that it appears as though companies do not actually spend the money that they raise in their IPOs. So companies go public, they raise money, but they don't spend it. When you look 3 to 5 years after the IPO, that very same money is still sitting on the balance sheets as cash. So companies go public, and they say they go public in order to fund investment, yet there's no evidence of that. The cash remains on the balance sheet. That's the third fact, and a very surprising one. And the final fact is that IPOs appear to be disappearing in the US. Companies are voting with their feet and not going public as much as they used to. Let me illustrate that with some statistics. I'm going to show you 4 charts, one each for 4 markets. Top left, you've got a somewhat snowy picture of the New York Stock Exchange. We have snow in New York, unlike you here. Top right, you've got the Frankfurt Exchange. Bottom left, Hong Kong, and then bottom right, you've got the London Stock Exchange. So, I'm going to show you the number of companies going public in each of these markets per year. And first of all, I'm going to show you evidence going back to the 1960s and ending in 1999. So you can think of that as ancient history. So top left, you've got the US. You've got hundreds of companies going public in the average year. It's been a very active IPO market. You've got in the 70s the likes of Apple and Microsoft going public, 70s and 80s, and lots of IPOs by dot-com companies in the 1990s. On average, about 350 companies went public in the US every year. Then you've got Germany on the top right. You see no IPO activity in the 60s and 70s up until about 83. There were actually one or two, but the scale is such that you can't discern them at this scale. Then in 1983, the IPO market started for real in Germany when something like 8 companies went public. And that was a big sensation. All the newspapers had headlines about it. It was called an IPO wave, 8 companies. And it remained at the level of about 10 to 20 throughout the 80s and 90s until about 98, 99, the last 2 years on the chart, when Germany too had a boom in IPOs by dot-com companies and similar kinds of new economy stocks. So Germany ended the 1990s at about 180 IPOs per year, much less than the US, but a very high growth rate. Then bottom left, you've got Hong Kong. Not much of an IPO market to speak of until the 80s, and then somewhere around 50 a year or so, a much smaller market than the US. And then finally, you've got the UK, which traditionally has had a very active IPO market on the order of 100 plus a year, and amongst the 4 charts here, the second most active after the US. So that's ancient history. The US traditionally had the most active IPO market in the world. Now look at what happened after 1999. I'm going to show you evidence. The first, on the left, you've got the 1990s, and then you've got the 2000s. On the top left, again, you've got the US. You've got a very active IPO market until 2000, and then it crashes. The IPO activity goes from several hundred a year to below 100 a year in 01, 02, 03. It recovers a little bit, reaching 180 or so, and then during the crisis, 08, 09, again being very subdued. So the level difference here is remarkable, from several hundred a year to 150 or something a year. It's about a 60% drop in IPO activity in the US. If you look at Germany, you've got, in 2000, the same kind of drop-off in the level of IPOs. The dot-com bubble burst, fewer companies went public, but then it recovered quite remarkably. In the mid-2000s, hundreds of companies again went public. And if you look at the US by comparison, that recovery just never happened in the US. And in fact, in the mid-2000s, there were more companies going public in Germany than there were in the US. Now, the US is a much larger economy than Germany's, and yet Germany all of a sudden had a much larger IPO market than the US. First time ever. Then you've got Hong Kong. Hong Kong didn't have much of a bubble bursting in 2000. In fact, Hong Kong just chugged along very nicely with about the same number of companies going public throughout the 90s and throughout the 2000s. Somewhere on the order of 50 to 100 a year. Much of that is driven by China, obviously. And if you look at 2009, which is the last year in this chart, then, and you compare Hong Kong to the US, you see that actually more companies went public on the Hong Kong Stock Exchange than in all of the US in 2009. It was quite remarkable given how tiny Hong Kong is, even if it serves China. And then finally, you've got the UK. Similar picture to Germany. Drop off in 2000, but then a very nice recovery in the mid-2000s, overtaking IPO activity in the US, suffering from the crisis, not surprisingly. But again, the US is the market that really stands out here. It had a decline in IPO activity in 2000, we understand that, but it never recovered. So IPO activity in the US is down to a very large extent. So companies are voting with their feet, and indeed, increasingly what you see is US companies going public to the extent that they are going public, not in the US, but on foreign markets, including in London, which also is quite remarkable. Companies voting with their feet, listing somewhere else. So against this background, what I want to show you is some evidence that compares public and private companies in the US. It looks as though there's certain costs associated with being public. They're to do with agency conflicts that may arise once you separate ownership and control. And those agency conflicts may very well make it less desirable to be a publicly traded company these days. And you saw that there are fewer publicly traded companies in the US than there used to. Now, in order to compare public and private companies, we need data on private companies. And until very recently, no such data existed for the US. So we were basically in the dark. We, the world, we academics. So there's a huge amount of work, empirical work by academics on publicly traded companies. We had great data on publicly traded companies and almost nothing on private companies. Now this situation has, as I said, recently changed because a new database has become available that tracks private companies in the US. Those of you who are familiar with a database called CompuStat may recognize this new data as being quite similar. Now, CompuStat is an accounting database for publicly traded companies in the US. It contains balance sheet information, profit and loss account information, and so on. And those of you who work in finance will be very familiar with it. So that's what I said when I said that we have a lot of work on public companies in the US. Much of that is based on CompuStat. Now, the new database that's come along is basically like CompuStat. It's called SageWorks, but it covers private companies. So it covers balance sheet information, income statement information for more than 100,000 firms in the US, covering more than 350,000 firm years. This is an ever-growing database that adds ever more information beginning in 2001. So you have great accounting data on private companies, really for the very first time, that allows you to compare public and private companies on a number of different dimensions. And I want to show you a few of those dimensions. I hope you can see this. I'm going to compare public and private companies, public from CompuStat, private from this SageWorks database, on 4 dimensions on this slide: sales growth, profitability, how much cash they have, and their leverage, or how much debt they use. So when you compare companies, you find that sales growth is pretty similar. The average public company grows by about 18% a year. The average private company grows by about 17.7% a year, and the difference is too small to be statistically meaningful. Public companies are less profitable on average than are private companies by a full percentage point. So that's quite a large difference. Public companies, very surprisingly, hold much more cash than do private companies. 22.5% of their assets are held in cash on the balance sheet versus 15.2% for private companies. Now, this is surprising because, after all, public companies have very easy, at least theoretical, access to the stock market, unlike private companies. So public companies should be able to raise money when they need it rather than hold money in case they need it. So it's surprising to find them hoarding cash in some sense. And then finally, public companies use much less debt than do private companies. That, of course, is not surprising at all because, after all, private companies do not have easy access to the stock market and therefore cannot raise equity and therefore are more reliant on debt. Now, this comparison is somewhat misleading because private companies on the whole are much smaller than public companies. Let me show you that. On the left, you've got essentially a fancy form of a histogram showing you the size distribution of public and private firms. The dashed line, which is on the left, shows you the size distribution of the private firms. And the solid line, which is on the right here, shows you the size distribution of public firms. And really the only thing that you need to notice is that private firms lie to the left of public firms. Private firms as a group are smaller than public firms. Not surprising at all. But in order to have a good apples-to-apples comparison, what I really need to do is to compare like with like. So I want to compare companies of similar size at least. Maybe I want to hold some other dimensions constant as well. And another one that is important is industry. So what I'm going to do is I'm going to find companies that are of the same size and in the same industry, one of which is public and the other one is private, and then compare them again. So the distribution of size, once you construct this set of companies, is on the right, and you can see it's a nice overlap. I'm now comparing companies that are of same size, roughly, and that are in the same industry. So now let's go back to the 4 characteristics. You find exactly the same patterns, even when you control for size and industry, except that the first difference, sales growth, also becomes statistically meaningful. Because what you find here is that holding size and industry constant, private firms are in fact faster growing than similar public firms. And in addition, all the other differences in characteristics still hold. So private firms are faster growing. That's not really what you would expect when you think about the stock market, funding investment, funding growth, and so on and so forth. So that's somewhat surprising. Now, where's that growth coming from? Well, in part it's coming from greater investment by private firms. Also completely surprising. When you compare the investment rate of public and private firms, either using all the firms in CompuStat and all the firms in SageWorks, so hundreds of thousands, or holding size and industry constant, you find the same pattern. You find that public firms invest much less than do private firms. In the matched sample, for example, on average per year, public firms invest 4% of their assets, whilst private firms invest almost 10% of their assets. That's a very large difference, and that fundamentally is driving the difference in sales growth. So private firms, not public firms, invest more. Public firms have easy access to the stock market, so this is quite surprising. Now, the final empirical fact that I want to show you is to do with how public and private firms respond to investment opportunities. What you would hope is that public and private firms take advantage of improvements in the investment climate and invest more. And I'm going to show you that that is true. But surprisingly, what I'm also going to show you is that private firms do much more of this than do public firms. Private firms ramp up their investment by much more than do public firms when their investment opportunities improve. That's surprising. Now, the way I'm going to show you that this is true is by showing you a table with a regression result. So I realize some of you will not want to be reminded of statistics from the days when you went to university, so I'll keep this as light as I can. And I'll show you only one regression in this table. The easiest way to think about what I'm going to show you is that it's a fancy correlation. What I'm trying to measure is how much investment changes as investment opportunities change. So I want to measure the correlation between investment and investment opportunities. And what you would hope to see is that it's positive. As investment opportunities improve, companies invest more. Now I'm going to divide up this correlation between public and private firms, because what I want to measure is whether public and private firms are equally sensitive in their investment as investment opportunities improves, or whether one is more sensitive than the other as a group. So that's what the regression does for us. So here's the regression. The very first coefficient, 0.136, measures the sensitivity of investment to investment opportunities, or the correlation between the two, for private firms. Note that it's positive. As investment opportunities improve, private firms invest more. So that's good. That's what we would expect to see. The little stars means this is statistically significant, so it's measured with some degree of precision. The second coefficient, the minus 0.097, shows us the difference in investment sensitivities between public and private firms. It's negative. What that means is that public firms are less sensitive to improvements in investment opportunities than are private firms. And the difference is quite large. If mentally you subtract one from the other, you get about 0.04. That would give you the investment sensitivity of the average public firm, compared to about 0.14 for the average private firm. So there's a very large difference in the extent to which public firms and private firms take advantage of their investment opportunities. And remember, public firms have easy access to the stock market and can fund their investment simply by issuing shares, something that private firms find much harder to do. The other small thing to notice here is that I've controlled for profitability. The first coefficient, RA 0.173, measures the profitability sensitivity of investment for a private firm. Really all that's saying is that the more profitable a firm is, the more it's going to invest. And you find that that sensitivity is different for public and private firms. It's lower for public firms, meaning that public firms are less constrained in their investment decisions by how profitable they currently are. That makes sense. They can raise money quite easily. So to sum up those two patterns, private firms invest more when investment opportunities improve compared to public firms, and they do so despite the fact that they cannot as easily raise money and that their investment is much more dependent on how profitable they currently are. So that's surprising. Now, I did say I was only going to show you one regression. I lied. I'm going to show you another. What I've done in the previous table, in the previous regression, is to compare public and private firms. And I'm hoping that I'm comparing like with like, firms of similar size in the same industry and so on. But of course, firms are going to differ in all sorts of ways that I have no way of measuring. So what I want to do to see whether this pattern actually exists for real is to compare the same firm over time to itself as it goes public. I want to see whether a firm becomes more or less sensitive to improvements in investment opportunities as a function of whether it's public or private. So I'm now comparing the same firm to itself over time around the event of its IPO. So here's another regression. Again, these are just correlations in a fancy way. What you have on the left is the change in investment spending by the firm when investment opportunities change, whilst the firm is private. That's the first coefficient. And then the difference in its investment sensitivity from before to after, comparing when it was private to when it becomes public, which is the second coefficient. So first coefficient again measures the investment sensitivity of a private firm before it's gone public. It's positive. Firms invest more, the better their investment opportunities. That's great. The second coefficient tells you what happens to the investment sensitivity once the firm has gone public. It's negative. The investment sensitivity is reduced once that very same firm is now a publicly traded company. And that difference, as you can see, is quite large. So firms start off taking advantage of their investment opportunities. They go public, and then surprisingly, they take advantage of their investment opportunities to a much lesser degree than they used to, they themselves. One final regression. You might say the firms that we're talking about here might have gone public at a time when everybody reduced their investment sensitivity for whatever reason, maybe a recession or something that I can't even imagine. So what I really want to do is to compare the change in firms' investment sensitivities before and after they're public to other similar firms at the same point in time that are already public. So I want to take out the effect of what affects everybody if everybody's reducing their investment sensitivities at the same time, or something like that. So now I have three coefficients. The first line here, the small positive number, gives you the investment sensitivity of a public firm. Public firms take advantage of their investment opportunities improving, but really not by very much. It's a small number. The second coefficient gives you the investment sensitivity of a private firm that will go public, but before it's actually public. That's positive, and it's quite large. So compared to already public companies, a private firm that will go public, but whilst it's still private, takes advantage of investment opportunities with much more oomph. And then the final coefficient gives you the difference in investment sensitivity of an already public firm and a firm that used to be private but has now gone public. That difference is 0. So what does this mean? A firm that goes public, before it's gone public, is quite sensitive to its investment opportunities. Once it's gone public, it's less sensitive. In fact, once it's public, it's indistinguishable from other already public firms in its investment behavior. So it looks as though private firms, when they go public, converge on some sort of norm, if you like, of behavior, of investment behavior, that is the norm amongst public firms. And that is to not be very sensitive to investment opportunities improving. Very surprising. So let me summarize that for you. What we find is that both public and private firms do take advantage of investment opportunities. These coefficients are positive. Investment increases when investment opportunities improve. But private firms do so much more. Their response is more than 3.5 times greater than similar public firms. And then when you look at the same firm over time, you find that firms that go public reduce their responsiveness to investment opportunities. And the second result is that private firms' investment is much more sensitive to their profitability or their cash flows, which suggests that they don't find it as easy to fund investment because they can't raise money as easily. So now what you have is a trade-off here. On the one hand, a stock market listing reduces these investment sensitivities, reduces these financial constraints, makes it easier for firms to raise capital, but at the same time somehow makes firms less responsive to investment opportunities. So the big question is how? Why is this happening? Now I started off by introducing you to the ideas surrounding agency problems, and agency problems probably play a role here. Once you're a publicly traded company, your ownership structure will look different. You will probably have agency problems, at least to some extent, and they can take different expressions. One of which could be empire building. But empire building doesn't really fit the facts, because empire building says you have a manager who likes running a big company, and therefore he'll invest come what may. But of course, we don't see that. We don't find public companies investing more than private companies. We find the exact opposite. Second agency problem could be that firms are now run by managers who want a quiet life. They don't want to do the really time-consuming bit, which is vetting investment projects, taking on the unions, expanding, and so on and so forth. They just keep the company small. That could explain the facts. And the third is short-termism, which is the notion that public firm managers become too focused on near-term results, let's say quarterly earnings, than the long-term value maximization for the firm. And because they're too focused on near-term results, they will avoid investing too much today, because investment will reduce earnings and cash flows today. Now, the further test that you can do, and what they will do is they will favor short-termism as the explanation for the patterns that I've shown you. It really very much looks as though short-termism is what's driving the behavior here. And then there's some final evidence that suggests that public firms tend to engage in financial decisions that are quite different from private firms. In particular, they tend to smooth the earnings from quarter to quarter, and they tend to smooth the dividend payouts. So they keep their dividends stable compared to private firms. Private firm earnings and dividends are very volatile over time, and they're much smoother for public firms. Let me say a couple of words about short-termism. The root cause of short-termism is that managers are excessively focused on the next quarter's results. And that could be because shares are easy to trade these days. There's great liquidity. And if the stock market misinterprets low earnings today, that really reflect investment that will be productive in the future, as being a sign of weakness for the company, the share price will drop as shareholders sell. So the fact that it's very easy to trade shares might actually make it harder for management to do long-term investments rather than deliver short-term results. A second reason might be that the pay packages are explicitly linked to short-term earnings. We find that very often. Third could be that a variety of shareholders think perhaps activist hedge funds as shareholders put pressure on management to deliver high profits in the near term. And the final one is that CEO tenures, the length of time that they spend with their companies, has been much reduced over the last decade. CEOs are now in post for just a few years before they move on or are fired, which in turn presumably induces a shorter-term horizon amongst CEOs. Why invest today if the benefits of that investment won't accrue to you, but to your successor, or maybe your successor's successor? So against this background, there's survey evidence that suggests that companies and managers are very worried about short-termism. There's a very interesting survey result that came out about 5 years ago by Cam Harvey and others, who say that the majority of managers they surveyed in the US would avoid initiating a positive NPV project, making a profitable investment, if it meant falling short of the current quarter's consensus earnings forecast. That, of course, is insane, because the way that you maximize the value of the company is by investing today in order to get higher profits tomorrow, positive NPV. So managers admit to doing this, and the evidence that I showed you is consistent with managers behaving in this way for public firms. Private firms, on the other hand, behave much more in a way that's consistent with long-term value maximization, which makes sense because private firms are different ownership structures. Usually, you have the manager owning the business or being a very large shareholder in the business. So behaving in a short-termist manner would mean shooting yourself in the foot if you're the private firm manager. So let me wrap up before I move on to questions. We think about the stock market as being a source of funding for investment. That's probably what we've been taught in days gone by. But increasingly, the stock market does not, in fact, fund investment. It's just not something companies use the stock market for very much. In fact, we find more investment amongst private firms in the US than amongst public firms. So the exact opposite of what you might have expected. Now, one interpretation of the body of evidence that I've introduced you to is that public and private firms behave very differently. Public firms decide on their investment after they've satisfied a number of constraints, such as keeping the dividend stable. So as their investment opportunities improve, they might only take advantage of the investment opportunities improving to the extent that they've already been able to maintain their dividend. And if there's any cash flow left over, they'll go out and invest. Private firms, on the other hand, behave in the exact opposite way. They look at their investment opportunities, and when they've improved, they invest more. And if that means cutting the dividend, then so be it. They will cut the dividend, making the dividends for a private firm very volatile over time. But that's okay. You can explain that to your shareholders. Your shareholders are probably you yourself, maybe your family, and so on. So you can explain to them that the reason that the dividend today is low is because there was this wonderful opportunity to invest in China and we built a factory there. For a public firm manager, this apparently is much harder to do. Communicating with investors the sense of making an investment decision, making sure that it's not misinterpreted and thereby leads to a lower share price, appears to be much harder for a public firm manager. So finally, the evidence is consistent with this short-termist pressure coming from earnings, quarterly earnings in particular in the US. So I want to end by raising the following question. The stock market doesn't appear to really fund investment to a very large extent in the US, which leaves us with the secondary function of the stock market, the trading amongst shareholders. So clearly that is a very, very large activity indeed. Turnover on all the major exchanges around the world has been ever increasing every year with a few dips and recessions and so on. So shareholders are very much using stock markets to trade. And alongside this increase in trading, you've had a huge decline in trading costs. It's become ever easier to trade, ever cheaper to trade. And that's stock exchanges buying each other up and investing in IT and slashing commissions and so on and so forth. And the great benefit of doing all of this is that prices have become much more sensitive to information. So the efficiency with which shares are priced on the stock exchange has probably gone up a lot over the last 10, 20, 30 years. And shareholders can very easily trade out of shares, except, of course, in the financial crisis when liquidity disappeared, as we all know, but in general. So what the financial innovation has done is to improve liquidity on stock exchanges. But I wonder whether that's come at the expense of a different type of efficiency, namely the real efficiency in the economy, the role of the stock market in funding investment. If we've made it too easy for shareholders to vote with their feet and sell at the first sign of trouble, rather than take the trouble of getting to know a company, understanding its economics, understanding its decisions and what they really mean for the long-term value of the company, then maybe we've left ourselves with very little room for using the stock exchange to fund corporate investment. And maybe therefore we see far fewer companies wanting to be a stock market listed company, preferring to be private, at least in the US, and fund their investment as private companies, even though that is more expensive. Thank you very much.
Professor Ljungqvist, thank you for your presentation. I'm from NYU, by the way. So I have a question. Do you suggest any ways that public ownership would become profitable again, more profitable than private firms? Any global suggestions, for example, how to increase responsibility among CEOs and stuff like that? And a second question is, you said that this situation is relevant to United States stock market exchange. Is it the same in developing countries like China, Russia, or Brazil?
Okay, let me take your second question first. The answer is we don't know. And the reason why we don't know is because we don't have any data. Getting data on private companies is very difficult. Private companies typically don't have to report anything to anybody, and therefore really understanding what they do is hard. So we can't answer your question. There's some data that covers Europe. It's not very good data, but to the extent that you like that data, you find the opposite pattern to the US. You find that public firms invest more than private firms and invest in a way that's more sensitive to their investment opportunities than private firms. So the exact opposite of what we see in the US. It could be that because the data is not very good and I have my own doubts about the data in Europe, or it could be because really public firms in Europe are perhaps empire builders, liking making more investment in a way that perhaps is inefficient. But it's pure speculation. So that's the answer to your second question. In terms of your first question, you see, a lot of work has gone into trying to come up with the optimal corporate governance regime for publicly traded companies. So let's tweak stock market regulations a little bit, saying, for example, that a majority of directors on the board have to be independent of management, or something like that. And then let's hope, that's been the ambition behind it, that that will improve corporate governance and thereby improve firm performance a little bit. But the evidence that I've shown you is net of these corporate governance reforms and corporate governance mechanisms that are in place. What I mean by that is, despite the existence of a lot of time and effort that goes into trying to monitor management and design optimal corporate governance, we still find that public firms behave in a way that looks inefficient compared to private firms. So what that's telling me as an economist is that these corporate governance mechanisms probably improve the situation compared to if they didn't exist, but they're not enough to overcome the fundamental problem, the agency problems that I talked about. So what then is the global recommendation, as you phrased it? It's probably not to come up with ever more detailed corporate governance prescriptions, but it's to go back to the root cause of the problem, which is the separation of ownership and control. It's the idea that a stock market listed company, once ownership is highly dispersed, will have these problems. And you can try and remedy them, but the problems exist. So then the solution is to not have dispersed ownership. It's not much of a solution, but it's a step in the right direction. In other words, if you are going to have stock market listed company, make sure that the owners in the company have a sufficiently large investment in the company to really care about it. What that's going to do is two things. First is, if I own 5, 10, 15% of the company, even though I'm not running it, I will monitor it because it's my interest to do so. And secondly, if I own 5, 10, 15% of the company, I'm no longer a liquid shareholder. It's quite difficult to trade out of that larger position. So the liquidity, I'm undermining the liquidity, is going away and therefore is going to incentivize me again to do more monitoring. It's not much of a solution, but this dispersed shareholders, widows and orphans owning stock in companies is probably not the way forward.
In your opinion, do you think allowing insider trading could create more transparency and eliminate some of these problems that are associated with agency disputes or conflicts?
That's a very loaded question. So the debate around insider trading is a very tricky one. And the extent to which there's a consensus in academic circles goes something like this. Insider trading is a good thing. I'm not representing my own view, I'm representing consensus view in academia. Insider trading is a good thing because what it does is to make sure that the price reflects all the information. So now what you have is management knowing something, trading on it, uninformed investors in the market not knowing what the information is, but observing the trading and inferring from that that the information must be good or bad depending on the trading pattern. And then eventually the price will incorporate the information, even though it started off being private insider information. So if we care about pricing efficiency, insider trading is a great thing. But I'm not so concerned about pricing efficiency here. I think we have great pricing efficiency already. What I'm more concerned with is the stock market not fulfilling its primary function, which is to fund investment. So that's a different problem. If we make the stock market even more pricing efficient, that's not going to help with the problem that I'm focusing on here. Now, a different twist on this pricing efficiency argument is that you now have hedge funds trading in very much real time, trading in terms of milliseconds, on tiny, tiny differences in prices. So you've got competition amongst hedge funds in being ever faster in incorporating information in share prices. So we're making share prices ever more efficient in terms of pricing on a time scale that was unimaginable even 5 years ago. If you go back, let's say, 200 years, information would have been impounded very slowly in prices. If you're a merchant adventurer and your ship sinks in the South Sea, then that news is going to reach you in London with months of delay. When it does, your share price will fall. We've shrunk that time difference from years, months, days, hours, making prices ever more sensitive to information. But now we're at the scale of nanoseconds. And the broader economic gain from making prices efficient on that scale are completely beyond me. So that's a very long answer to your question.
Thank you for a very stimulating talk. Your data is, if I may say, it's very general, and the stock market economy covers very, very many very different types of companies. For example, you have cyclical companies, companies like the pharmaceuticals with long development periods, and actually a relatively short time when they can reap the return on that investment. So I would actually be very interested to see your data at a more granular level. I would also like to know when that data that you showed us, which year or which years was that gathered for? Because it seems to me that the jury ought to be out here. We've had over the last 10, 20 years some very major factors coming into play. You've had the arrival of electronic trading. You have the huge increase in the role of the fund manager communicating with the man in the street. So the man in the street owns far more. And then recently we've had the financial crash for various reasons and pullback, but also a sharp decrease, I would say, in the availability of bank lending to private companies. And I think that these factors need to be viewed over a longer term.
I think I agree with you. So the evidence that I showed you is 2002 to 2007. We can't go before 02 because the data only begin then. And I have no doubt that the 1990s, for example, would look very different. I don't know exactly how, but I don't think it would look the way it does now because of the trends that you described. We purposely exclude the crisis years because all bets are off in the crisis years. And in particular in a crisis, you've got the private companies being much more cash constrained, and that shows up very easily. Now, hopefully that's a temporary factor. Now, in terms of the nature of the evidence, you're exactly right. So the nature of the evidence is that these are broad averages. So these coefficients picked up the average behavior of a public firm versus the average behavior of a private firm. Okay? There are any number of ways of disentangling more granularity in that. And one in particular that we're focused on is looking at different industries that differ by the importance of short-term earnings pressure. So exactly how we measure that, I'll leave for another time. But when you do it that way, what you find is that the difference in behavior between public and private firms is greatest in industries where the pressure on short-term earnings, from short-term earnings, is the greatest, and is absent in industries where short-term earnings are uninformative about the future profitability of the company. So I haven't checked this in detail, but I think it's true that the example that you mentioned, pharmaceuticals, would be an industry in which short-term earnings are not all that informative about the future performance of the company, and therefore would be, in terms of what I just described, be one of those industries in which the distortion between public and private firms is quite small. So that would be an interesting take on that particular question.
You have, through your comments, explained in detail the fact that private companies are more effective or efficient as compared to the public companies. Now, my comment is that fundamentally speaking, the people who own public and private companies are in two separate groups, and I am talking about investor appetite or their purpose of investing into these companies. Now, a private company primarily is born out of the vision of an entrepreneur who wants to stay with that company for, let's say, 40 years. Whereas the appetite or the incentive for a guy who's investing into a public company is entirely different. These are two different set of groups of individuals who are there. Now, because of that very fact, while your comments hold, but isn't it true that these are both, their existence is very critical because there are two different groups for which they are equally important. Final point, for a public company, the sort of value that you create out of that company in a very short span of time for the investors as well, for the shareholders, that's something which is fundamentally different from the private company.
Okay, so there's a lot going on in your question. So I'm going to interpret the gist of your question as being the following. Can you actually compare public and private companies? Given that private companies are private for reason, public companies are public for reason, are they comparable? And that's a point that's well taken. It's always going to be difficult to make that comparison stick. I would say, however, that all public companies started off as private companies. So at some point they were led, presumably by an entrepreneur with the kind of vision that you describe, and at some point they decided that they wanted to be public. So we don't really know why they went public. If they went public to fund investment, which is what most of them say they do, that's not really borne out by their behavior subsequently, which is interesting. And even if you don't like the comparison between a public company and a private company of the same size and the same industry and so on and so forth, then the second comparison that I did, the same company over time around its time of the IPO, would make that argument go away. So here's a company that's decided it wants to be public. It's now got access to cheap funding through the stock market, and yet it behaves in a way, after it's gone public, that's much less efficient on the investment side. And I don't know why. I can speculate about why, but it's a very striking fact in the data. It looks like there's some agency problem going on. So I take your point that the comparison always has to be tricky. When you ask companies, why don't you go public? Then the kinds of answers that you get in surveys are exactly where you're coming from. Private companies stay private because they don't want the glare of publicity. They don't want outsiders telling them how to run the business. They don't want to share control with other shareholders, and so on. Makes perfect sense. So a lot of private companies stay private, not because they think they're going to be more efficient investors when they do that, but because there's something about being private that they value and desire, control, etc. But I think a perhaps unintended consequence of that choice is that they also end up being more efficient on the investment side. And from my point of view, the most natural explanation is because they did not change their ownership structure.
Professor, people have mentioned that the Sarbanes-Oxley has been the major driver for the reduction of the IPOs, and I wonder whether this applies the same way to the public versus private companies.
Okay, so that's a very interesting point. So Sarbanes-Oxley, for those of you who have not followed this debate in the US, came in 2002 in the wake of Enron and WorldCom and other accounting scandals. So it's an act of Congress that tells companies to become more transparent and disclose more and change their internal procedures and so on, with a view to avoiding Enron-style accounting scandals. Specifically from the point of view of a small company, Sarbanes-Oxley is quite expensive. Compliance with the new disclosure requirements under Sarbanes-Oxley, in particular the internal control mechanisms, has been estimated at an annual cost of about $1.7 to $2 million, just in terms of compliance. So it's extra fees to your accounting firm, basically. Now, if you're a small company making $5 million in annual profit or something like that, then having to comply with Sarbanes-Oxley is a very significant cost. The easiest way around Sarbanes-Oxley is to remain a private company, because as a private company, you're not caught by Sarbanes-Oxley. So people have argued that this duty to comply has made it more expensive, in particular for small private companies to go public, and therefore we see fewer IPOs. Now, I don't actually believe that's true. A couple of reasons why I don't think that's true. I think the timing doesn't feel right. So Sarbanes-Oxley came in 2002. The provisions that would make it particularly expensive for a small company to be public, so compliance with what's called Section 404, happened after 2002. They were phased in over time. Yet if you look at this chart, you find that the IPO volume dropped off not in 2002 or the years after, but in 2000 and 2001. So that's the first thing that I think doesn't quite fit the facts. The second thing is, what I haven't shown you here is that not only the volume of IPOs has gone down, but there's another trend change as well, which is that in the US, the size of IPOs has dramatically increased in the 2000s versus the 1990s. So IPOs used to be $50 to $100 million on average in terms of capital raised. Then in 2001, 2002, that spiked at about $1 billion on average, and then came down to $200 to $300 million on average per year. So IPO size seems to have had a step change, a step increase around the same time. Now, when you look at the data very closely, this step change happened in 98, 99. So even before the dot-com bubble burst and even before the volume of IPOs dropped, there was a shift beginning in 98 to very much larger companies going public, raising very much larger amounts of money. So we had a change in the IPO market from small companies raising small amounts of money to large companies raising large amounts of money well before Sarbanes-Oxley, 4 years before Sarbanes-Oxley, 2 years before anybody even thought about Enron's accounting looking a bit iffy. So Sarbanes-Oxley has been pilloried for a number of reasons, many of which I'm sure are correct, but not for this one. I don't think it's the cause of the IPO changes that I've described to you. So again, a very long answer to your question, I apologize.
As a young person interested in investment, how do you recommend that we learn sound investment principles? You can go on the internet and find a lot of misled, people that think you can plug in numbers into functions and find where the stock market's going tomorrow. And what are ways that we can grow up to be sound investors, I guess?
Career advice. Okay, so luckily that's a very easy question to answer. What do you need to do? I'm assuming you're a student here? Okay, so first of all, graduate. Once you've done that, couple of years, work experience, wherever you like, and then you apply to Stern and do an MBA with us. And then we'll teach you how to make sound investment decisions. But just aside, I think I'm going to hijack your question in a slightly different direction. I think there's too much talented young people going into fundamentally unproductive bits of the economy. And as a finance professor, this is a very controversial statement to make, but what I regard as part of the unproductive parts of the economy is making prices ever more efficient on a nanosecond timescale. So in some sense, I'm saying there's too much human talent going into hedge funds. There's nothing wrong with hedge funds. We need hedge funds. They're great for a number of reasons. But we don't need hedge funds to be trading on ever smaller timescales for ever smaller price differences. Fundamentally, that's a zero-sum game. Those hedge funds will make a profit at the expense of another investor who will make a loss. But there's no real value created for anybody other than those two parties to the transaction, because companies don't care about their share price being efficient, reflecting all the information on that kind of timescale. It's not of any value to anybody other than the party to the transaction. So I wouldn't mind if you went, after you get an MBA from us, into the productive parts of the economy, which could be working for an investment bank and helping companies grow, raise capital, and so on and so forth, or could be working in a financial function for a company and helping make better financial decisions inside a company. And I think we're seeing part of that restructuring in the workplace already, in part because the finance industry is shrinking. It was unusually large going into the crisis, 07, 08, and 3 times, in terms of size to GDP, the financial sector was 3 times its historical moving average by the time we went into the crisis, and it will surely shrink. And that's dreadful for people who are losing their jobs in finance, and wonderful, potentially, for the wider economy, if that means more talented people move into other parts of the economy. That's a very different answer to the question that you asked.
Just a quick follow-up. So is this the impact of Sarbanes-Oxley?
I'm sorry, what is the impact of Sarbanes-Oxley?
Small U.S. firms are still going IPO, but not in the U.S.
I think my answer is going to be very similar. So the trend of U.S. firms of that size and that capital demand not going public in the U.S. precedes Sarbanes-Oxley. The trend of companies going public outside the U.S., which really had never happened before, also precedes Sarbanes-Oxley. So for exactly the same reason, I think the answer is no, it's not Sarbanes-Oxley. If you ask me what's happening, which is the subject of a whole different talk, then as far as the IPO market is concerned, I think it's a change in the market structure of the investment banking side. So we used to have lots of investment banks that the man in the street has never heard of, that were very large players in the IPO market, in part because they specialized by industry and so on and so forth. So names that most of you will not be familiar with in this context would be Ljungqvist and Robertson Stevens and Alex Brown and so on and so forth. So these were specialized players that did a very large amount of IPO work. Now, they were acquired in the late 1990s by the big banks, Deutsche Bank and Bank of America and so on and so forth, and essentially closed down. And with the closing down, you had not just the loss of specialists who used to do these specialized IPOs, but you also had the loss of financial analysts providing research coverage for these companies once they were public. And that's a very important part of the communication game, explaining the companies to investors to make sure that when companies announce, let's say, a change in investment, investors don't vote with their feet running for the exit, but instead think about what that really means and how that might actually be good for the company. Now, these specialized boutiques were closed down. The analysts largely migrated out of the industry, and the remainder of Wall Street started to cover much larger companies rather than these relatively small companies. So in some sense, the effective minimum efficient scale of being a publicly traded company in the US changed. If you were too small, there was no longer anybody paying any attention to you. So that doing a small IPO, the banks weren't interested, and the analysts weren't interested in covering you afterwards. Doing a small IPO became that much harder. And I think that, if one were to expand on this and so on, think about alternative explanations, that would stand out as the most likely explanation rather than Sarbanes-Oxley. Much of my research is in the area of venture capital and entrepreneurial finance. So what happens before companies get as far as the stock exchange. And one of the big questions in venture capital is whether venture capitalists add any value. Now, that may be a question with an obvious answer, but it's very hard to measure. It could be that venture capitalists are just very good at selecting the companies that will do well anyway, or the companies end up doing well because of the inputs that the venture capitalists provide. And I don't just mean signing a check. I mean being an active investor, sitting on the boards of directors, helping the company succeed and so on. And these two alternatives, selection of companies that will do well anyway versus value add, disentangling those two is very difficult. But much of my current research is focused on trying to get a handle on exactly that problem.